Welcome to Market Radar. We're not investment advisors, security analysts, or brokers. The following information is strictly for entertainment and educational purposes only. None of the information here is intended as a buy or sell recommendation. It's March 6th, 2022. My name is Artie, and I'm here with co-host Gamma.
Hey guys.
So let's get started. What happened this week? So S&P year to date, these are all year to date. S&P is down 9.01%. NASDAQ is down 15.22%. Russell is down 10.69%. And the Dow is down 7.39%. All indexes are still bearish trend on our indicator. We still have a strong stagflation regime. We have an 85% confidence interval, and deflation odds are creeping up. Deflation odds have risen very slightly, 0.3% since last week, but so have stagflation odds. And what that's essentially telling us is we're in a shitty stagflation, and it's stagflation typically, historically, it's very, very choppy, very flatlined. But with the market pricing in this deflation as well, that's why we're getting a lot of strong down moves in a lot of securities. So we're kind of in near the axis between stagflation and deflation.
Yep, and I'll take it from here. So let's go look at before we get off this page, let's look at the system strength. And this goes back to the 85% strength indicator. We are almost at the peak. Obviously, the peak is 100, but we're getting up there. Another week like this will be in the 90s, and we'll be at the upper percentile of recorded system strengths going all the way back to 2006. And that's quite interesting because usually stagflation, as you said already, is the pivot to deflation. It's what we get before we get the full risk off regime. And we have one of the longest stagflationary periods since 2006 right now. And that's pretty interesting because, like I said, usually we'd be in a deflationary environment right now. And there's a lot of things that our model is picking up that's keeping us in stagflation, and we'll go over that later. But it's just important to note that equity markets are going to trade like they're in between stagflation and deflation. So you're going to get that chop, not that knife down every day, like you saw at in the end of 2018 or even COVID. It's more of a gap down, trap the longs on the way up, and then squeeze them all the way down again. That's really what you're seeing every single day. So let's go over the calendar for next week. Um, Tomorrow, not much is going on. We got some bill auctions, some consumer credit. Tuesday, we have international trades in goods and services, which is going to be the most important. If you guys don't know, when you're looking at this screen, the red dots are market sensitive or market moving events. Everything else is just status quo, normal, weekly. The red indicators are market sensitive. And this is the screenshot that comes with the morning tweet every morning on Twitter and Discord. And the link to this is under econday.com, us.econday.com. You can find a calendar there, and that's the calendar that we reference. So let's get back to it. Tuesday, we have the international trades. Wednesday, we have the petroleum status report, 10:30 a.m. Thursday, we have the two most important ones that we're going to have this week are the CPI at 8:30 a.m. on Tuesday and jobless claims at 8:30 a.m. on Tuesday, both Eastern Standard Time. This is what everyone's watching. CPI. We had estimates come in for this in the last week at 7.8 and have been revised higher to 7.9. We are currently at 7.5% year over year. We believe that we're going to get an 8 handle on this inflation report. I don't think you're going to get under 8, but we'll see. Oil, all commodities ripping. So I don't see how you're going to, it's going to, it's obviously not going to slow. The matter is how much higher is it going to go from here. I do think we break the 8 handle and we start, we get into that territory, especially with what's been happening with crude and wheat and all food and energy and whatnot. So that's going to be it for the week here, where we finish off with consumer sentiment, which has been getting bombed as well. It's nothing that's pointing towards any bullish price action. So that's probably going to disappoint, but we'll see. Um, let's go to the FOMC calendar. So for those that are listening to this over over voice and don't have access to the video, I'm going to start off by just saying the most important thing of the Fed Watch tool, and that's the meeting probabilities tab. That's what we look at where we want to see what's being priced in each meeting and the odds of the outcomes of the of possible rate hikes. So there are 2 columns. There's a meeting date and there are the probabilities, and the main row on top is gonna be the number of rate hikes. So rate hikes are counted in 25 basis point increments. So, 0 to 25 is what we're at right now. 25 to 50 is 1 rate hike. 50 to 75 is 2 rate hikes, and 75 to 100 is 3 rate hikes, and so on and so forth. So we have a meeting in a week, roughly a week and a half, on the 16th of March. And the current probability for a rate hike for one rate hike is 92%. The odd of no rate hike has actually risen. It was close to zero. Now we're at 8%. So that's what the market's pricing in right now. There's an 8% chance the Fed doesn't hike rates in a week and a half. And there's a 92% chance they do. And in the
So,
following, go ahead.
um, is this going to be enough to slow inflation?
Absolutely not.
Yeah.
This is a joke. This is a joke, but I'm going over this for the people that are listening so they understand. But this is obviously a joke. One rate hike is, you know,
Yeah, that's
like
that's
it's
going to
like
do
throwing
nothing. Like we've
it's like
got
throwing a it's like throwing a cup of water on a forest fire. That's what
yeah,
it's doing.
like we got oil gapping up to 124. Inflation's raging. It's going
Yeah,
crazy. But
and they'll tell you it's transitory. I know. Yeah, it's a
what
joke.
so what is their plan? Like I think I think they want inflation and they're going to keep inflation going for a little longer. That's why they're not being aggressive with rate hikes.
Right, and like let me take that from there with the rest of the curve here. So that's a good point to make. You can see by the chart, and I'll explain it for those that are listening. We get up to 4 rate hikes from now. 4 rate hikes from now is July 27th, 2022. That's a 54% chance that we are going to be at between 100 and 125 basis points, and that's 4 rate hikes, just making sure. Yes, that's 4 rate hikes from now. So, that's really slow. I mean, there's been talks of 50 basis point rate hikes, which could cut that time in half. Again, the Fed's not the type to surprise markets, so we're probably looking at 25 basis point hikes, and the Fed is going to do what the Fed is going to do, and what that means is the Fed is going to hike so far that they're going to hike too far and they're going to have to start cutting. This is the Fed's notorious for this. They like to hike at the worst times, go longer than they're supposed to, and then have to cut when they should have done a while ago. Similar to the Fed should have been hiking a year ago. The fact where the first rate hike is coming on March 16th of 2022 is a joke. Like they couldn't have seen this. They're supposed to be the central bank and they couldn't have seen this coming. They printed trillions of dollars. Like, where did they
And
not see the problem here?
and now in a way worse situation
Yeah. Yeah,
than they
this is
were a
the
year
yeah.
ago.
This is the meme of the Fed. They like to, they get too deep in the water over too much time and they have to swim their way back out and they never actually do get back out. So, it's take the analogy, take 2 steps forward, 1 step back, that's the Fed, but going backwards, never going forward. So the Fed's always taking 2 steps backwards and they're like, "Oh, we're going to take a step forward," and then they take another 2 steps backwards. So we're always going backwards. We're really never fixing we're kicking the can further and further down the road, but then they stop and they pick it up just to kick it further. That's what's going on here. This is going to be a problem that eventually down the road we're going to have a currency issue with the US dollar as the reserve currency, but that's not going to happen right now. The world is, just to say this simply, too fucked up right now for the US dollar not to be the world's reserve currency. I mean, you have the ruble pretty much, you could wipe your ass with the ruble at this point. Like it's worth nothing. And I feel terrible for those people. What do you do if you live in think about it. You live in Russia, right? And your currency gets devalued overnight, that by that much. Wages are going to take the way economics works is wages take a while to implement. Obviously, they'll be faster with the aggressive devaluation, but do you even go to work anymore? Do you
Yeah,
show up? Like,
productivity is just going to plummet.
yeah, exactly. And it's terrible because it's not their fault. It's not the people of Russia didn't do this. You know? They didn't want this, nor did the people of Ukraine. So it's terrible what's happening over there and I wish that they find some hope and a way out, but it really is just a sad thing. It's something that it's destruction of government. It's governments destructing civilization for political gains or objectives that are outside the scope of the actual benefits of the civilians of the nation they belong to. And what I mean by that is it's governments doing shit that has no real merit to the country and the citizens that they're supposed to be representing, you know does nothing for the Russian people to do that to Ukraine. Does nothing, the Ukraine battling against wanting NATO, not sign. It's just it's a constant mess, which requires it doesn't have to happen.
Yep.
It could be.
And
There's definitely a way to resolve it more peacefully, is what I mean. Some things happen. Obviously, saying it doesn't have to happen is probably the wrong way to say it. But there's more peaceful ways to resolve matters like that than what's going on right now.
well, while we're on the topic of currencies, let's talk about the US dollar because
Right.
right now
Okay.
we're in stagflation, right? So
Yeah, that's
stagflation
yep.
is, and we're deep in stagflation. So that's high inflation and low growth. Yet the US dollar is strengthening.
Right.
And
So
that's due to every other currency weakening relative to the US dollar.
right. Let me pull up the dollar index in a second, but before I leave the Fed watch tool, I just want to emphasize the that we're looking at roughly 5 rate hikes by year's end. The odds are that we're going to get up to 5 rate hikes by year's end. That's what's being predicted right now. So we'll leave off with this and we'll go to trading view, which we'll bring up the dollar. We'll bring up dollar futures, and as you said, Artie, they are ripping. We are at 98.92 on the U.S. dollar index futures. To give you some reference for those that are listening, the high that we had during COVID was roughly 103, 104. The low, which we were pricing back in May of 21, is 89. So we are well beyond mid range. We are approaching $100. Remember, the high is 104. So, yes, dollar is ripping. Why? This is a good point. Most people don't know the dollar index's composition is of other currencies. As it might not make sense, but the dollar's value is derived from the value of other currencies. The dollar is a basket of currencies, basically, in simple terms. The dollar includes the euro, the yen, I believe the Swiss franc. The euro is the biggest component. I can tell you that much. I mean, Artie, if you want to pull up the statistics or the composition index while I'm talking, probably it's a good idea to give some more clarity on that. So the reason the dollar is going up is simple. other countries are experiencing inflation, and the currencies of their countries are less trusted than a dollar. Like, this goes back to the dollar being the world's reserve currency. So, ruble, for example, euro, for example, all these countries are in pretty shitty conditions. I mean, the European Union has so many different countries in there. You got Greece that's been defaulting for like 10 years, right? These are all problems that the euro has, and they're a component of each other's countries. So one country has a problem, it almost stems to the other countries, and this is the problem of the euro. This is the euro's. People are calling for the end of the euro or the euro breaking down. That's what you're seeing right now. It's just there's too many problems for one currency, and the euro breaking down is inadvertently going to push the dollar up.
Well,
And
yeah,
I
the
believe
euro is
is
the
40.
largest weight at
What's it? 40%? I'm just guessing.
57.
57%. Yeah, there you go. So 57% of the dollar index is the euro. So you could see the euro pretty much going in the toilet is going to push the dollar higher. It's just what it is. Now, we also have an issue here with what the Fed is going to do. So we'll get into that in a little bit, but we'll start with the next one under the dollar, which is gold. And gold is making a move higher. This has to do with the Fed as well, but we'll again talk about this in a little bit. We do not have a position in gold, and this might sound crazy given where gold's price is right now. We still don't believe that this is going to be a good medium to long term asset here in this regime. The reason being is interest rates. So gold hates and gold hates rate hikes. Bonds hate rate hikes. I can tell you right now that gold is correlated to real yields. So we believe real yields are going to go higher. They have been going higher, and then they came down, and I think I have the spread right here. So we saw them move up, and then mid last month they started, or late last month they started falling apart. We're back down to negative 98 basis points. We do believe the real yields get to zero, and that's going to come about via a slowdown in inflation and rate hikes. Now, at the speed at which we're going to see it get to zero, not too sure, but I think that the next three rate FOMC meetings are going to entail rate hikes. A lot of people are saying Fed's going to hike once and that's going to be it, and I just cannot see that happening right now. I mean, if you told me crude went back down to $70 a barrel in the next 2 weeks, uh, maybe, you know? I mean, we have crude, we have wheat, we have palladium. Pretty much all commodities are ripping because of Russia. Russia is a supplier of a lot of these commodities, you know? Russia supplies like 40% of the palladium. It supplies 40% of the energy to Europe. They're a huge producer. And a lot of things stem off of Russia. Outside of these commodities, like the basic commodities, they stem from Russia, but the utilization, things like cars, TVs, all these things that require these metals and commodities, they come originally from Russia, and then they're manufactured somewhere else. So this problem we have with Russia is not going to be ended, or not going to be resolved, I should say, rather quickly. As you can see, we're not going to go from annihilating Putin to hugging him and going back into the trade agreement we just had. This is going to last a while.
Well, so hold on. I got a question here. So
Go ahead.
gold doesn't like rising rates because rising rates slows inflation.
Right.
Could it be that gold is still ripping because nobody believes that what the Fed is going to be doing is going to slow inflation? So inflation will be persisting.
Well, that's a great point to make, and I think you don't have to just look at gold. You can look at something like, this is our ETF version of the CRB index. Look at this thing.
And that's DBC.
That's
right?
DBC. Yep. So that's the Invesco Commodity Index. For those listening, DBC is up 15% in a week, 19% in a month, and 30% year to date. The thing's vertical. Thing looks like a penny stock. And this is the commodities index. So that's a good point to make. And I'll elaborate on that with gold. I think this is my theory on why gold's going up. You have two main things pushing on gold's price or bidding gold up. You have the conflict with Ukraine and the Russian people that are left in misery, right? Like they're pretty, like we said earlier, they're pretty much unfortunately fucked. And then you have the Fed playing games where, or at least people thinking the Fed is playing games. I don't think the Fed is playing games. I know that they're known to be lackadaisy, but I think the Fed's got a real problem here, and I think that they know that, especially Jay Powell. He knows what he's got going on here. Um, and I think people are buying gold. This is the second bid on gold outside of Russia, is that they don't believe that the Fed's going to hike rates, or at least nowhere near something material, nothing that's going to be enough to matter. Again, like we said, we'll quickly bring up the Fed Watch tool. We're looking at one rate hike, and realistically, everything after it, this first rate hike is up in the air. I mean, odds are odds, but these can shift. They can shift. These can shift all over the place depending on what the Fed says in this next meeting. But the idea is that they're going to gradually hike all the way out to the end of the year. We're going to get 5 rate hikes in there. We had more like 8 at one point, but we're now at 5. So I think that people are saying, okay, we're at 8, we're at 5, we're going to fade. So buy gold. They don't, when, if you're long gold right now and you enter a position, especially at the prices at this point right now at above 1900, you are betting on a collapse of real yields. And what do I mean by that? You're betting that the Fed is not going to hike anywhere near enough to combat inflation.
Which
And
isn't that what we're seeing right now?
it's what you're seeing right now. But let me explain something to you about the Federal Reserve. They have two main mandates, okay? Or I should say, their two main goals. Let's not use the word mandates. It's max employment and price stability, okay? And for those that don't know what the Federal Reserve is, the Federal Reserve is supposed to be independent. They're supposed to be an independent organization that is outside of the reach of the US government, that basically controls the banking from one arm's length away of the country's finances. And if you don't know, the Federal Reserve is owned by the biggest bankers. So or I should say the biggest banks, not bankers. A great book for anyone to read that has some free time, or an audiobook to listen to, is The Creature of Jekyll Island. And that book literally tells you that the Federal Reserve was designed by the big banks like JP Morgan, all these banks that you know today. They are a part of the Federal Reserve, receiving special dividends, special treatment, bailouts, all sorts of crazy shit that, like, no person like you or me, if we open a bank today, would ever get or would ever be able to get that type of treatment. It's given to only those banks that are in the elite group. Now, it sounds like some crazy shit, honestly, if I say this. Like, you probably think that I'm out of my mind, but just take a quick Google search and who owns the Federal Reserve, and the answer is right there. Not owned by the government. It's not part of the government, which is why people get angry, because the government has nothing to do with the Federal Reserve. The Federal Reserve is supposed to be independent, but the Federal Reserve is always going to do what's best for the banks.
And it's kind of fucked because who voted for them? Who voted for the Federal Reserve? Like they just kind of appointed themselves.
Well, no, the book goes on and explains to you that the Federal Reserve was put in place as a price stability, or basically to prevent banks from going out and going under, a run on the bank. So it's really what it was designed to do. It's supposed to prevent banks from going out of business, but in reality, like, Yes, do they do that? Sure. But they also do so much other crazy shit that it's like, at what point is this worth it? You understand? Like the Federal Reserve, like I said, there's two main mandates are max employment and price stability. Okay. Jay Powell, during his testimony, got asked a question if he knew Paul Volcker. Paul Volcker. I don't know if you know who Paul Volcker is, but he's the man of the Federal Reserve, or the head, or the chairman of the Federal Reserve at the time, of their stagflationary period between the 70s and 80s, where he let the interest rates rip. He basically let them loose. And I think we can pull up a chart for those watching, of the 10-year yield at that time. Do a line chart. We'll take DDAP off for ease of use, but let's go back to 1980s. And no, we can't. We can't really see it, so we'll have to go to CPI year over year here. CPI inflation rate year over year. Yeah, this is what happened in the 80s. We had inflation go all the way peaking at 14.76%. 14.76%. Paul Volcker let interest rates rise substantially. I don't have the chart up here, but I think that they peak somewhere around 12% or even higher on a 10-year note, which is ridiculous. Do that today, huh, it'd be done.
Well, let's tie that into the problem that the Federal Reserve is facing right now. They need to raise rates to
Right.
calm inflation.
Right.
But can
Now,
can they afford that? Will
well,
America default if they raise rates too high?
that's the problem. That's the problem you're running into because the government can't service the amount of debt at that interest rate. If the government, so let me see if I can get this here. Um, we have the inflation rate here and we have the 10-year here. So let's overlay this. As you can see, this is the 10-year back in 1980s, right? We're at 14.7%. What this did was raising the rates above inflation. Pretty much their idea back then was we have to squeeze inflation out. So we have to let rates rip so much that inflation will go away. And sure enough, inflation got squeezed in a matter of a year. It was done. It was gone. It was done. We can't do that now. The amount of debt that the US holds or has generated, we can't service that debt at 10%.
Yeah, isn't it like the US is paying over 300 billion a year just in interest to service the debt
Yeah,
right
I
now?
don't I don't know the exact number, but it's a pretty high number. It's a number that, raising interest rates that high would never work.
And we're talking like 300 billion per year on like 1% interest.
Yeah,
You, all you
exactly.
all you have to do is go to 2% interest and
Right.
and all of a sudden you're paying 600 billion. So it's the Fed's in a pickle right now.
I know, and I guess the most important thing to segue off of that is that we're gonna see the Fed hike rates because they have to. I don't know how high they're gonna go, but let's look at the US 10-year on a daily time frame. We'll put the candles back on and do that. I think we're gonna get above 2 to 2.25, even 2.25 again on the 10-year. I don't think the 10-year is done. A lot of people are saying, so this is where the issue comes with the bond bulls. Okay, the bond and gold bulls. If you're buying gold and you're buying bonds right now, you think the 10-year peaked. You think that the last run we had in February, where we put our heads above 2%, that was the top. If you're buying bonds right now, that's what you think. That's your bet. Same thing with gold. Rates are done. Rates are going back down. I don't think so. I think rates are going higher. The Fed's going to hike. Inflation's continuing to run rampant. It's not slowing down anytime soon. So I don't think that this is the end for I think this is a dip in yields, or I should say a pop in bonds. Well, let's look at our bond proxy, our 10-year, our T-note futures. Where are they? They're up here. They're still in a deep bearish trend. For something to change, we would have to get above 131, hold and break. I should say break, hold, and push higher. If we don't get above there, it remains bearish trend. For those only listening, um, the T-note futures are the 10-year Treasury bond futures, or I should say Treasury note futures. And they flipped bearish back in October of 2020, and they've remained bearish ever since. And that's when rates really broke out. That's when the 10-year really started accelerating higher, where we got that pivot from, if we go back to our regimes, where we got that pivot from expansion, or I should say, excuse me, we got that pivot from deflation to expansion. And from there, we then proceeded to an expansion to inflation pivot. That all happened with the the uh, the T note futures breaking down. Long story short, with this T note futures is, as long as this is bearish trends, we're bullish on bond yields, and the 10-year at one is currently at 1.697. I think it could definitely go to Momo, which would really trap a lot of bond bulls if it goes down to 1.5, 1.56, 1.6 area, which is Momo. Momo's at 1.564. Get a lot of bulls trapped for it to bounce and run.
And that would not be unheard of
No,
in
that would
this
not be
regime.
unheard.
That's what happens. That's
Yep.
what you should expect.
Right. Inflation's not going anywhere anytime soon. Like I said, with this Russia thing, it's not going to fade away. It's not going to be something that in a month from now, 45 days from now, Russia is not an issue, or I should say the supply shocks of Russia's actions are no longer an issue. Russia literally just came out and said they're going to get off the internet. Think about that. They're going to go on their own internet. They
Yeah,
are not going to be
that's
connected to the world's internet. Think of does this sound like a problem that's going to be resolved in the next 30 days?
definitely not.
Right. And going back to what I said about Powell, where he goes, I knew Paul Volcker. He was being asked if he was going to do everything in his power to fix inflation. And they basically compared Paul Volcker's actions to what they thought Powell should be doing. And Powell said that he's going to do everything that he has to do.
We'll see.
I think I will see, but I think the Powell put has expired.
Yeah, you can only pull so many Powell puts. You can only kick
Yeah.
the can so far. But, like that people have been saying that. I remember when was it? 2018. Everyone thought, okay, the Fed kicked the can too far, and this is it. That was
That's
4 years
That's
ago
funny.
now.
That's funny you bring up 2018. So that was the whole thing going into 2018. The Powell conundrum with President Trump at the time. It had to do with Powell hiking into a slowing economy.
And
He
is
didn't
that
have
not what's happening right now?
you just hear me out. He didn't have to. Inflation wasn't where it was. Like, let's go back to inflation in 2000 here. CPI year over year. I'll show you guys. Where is it? Here. In 2018, inflation was at 2.7% going into the rate hikes. 2 point not excuse me, 2 point it peaked in July at 2.9% going into the rate hikes. Powell kept pressing rate hikes higher and higher. He saw inflation picking up, and he was hiking into inflation. Nothing was happening. But the economy was slowing. The economy was pretty much peaked. I mean, let's go back to our regime chart. We got a stagflation trigger. Where is this? We got a stagflation trigger. I believe it was roughly in September of 2018. It protected you from the downside, obviously, but still, inflation was not where it is today. For those wondering, or or can't, or for those that can't see that are wondering, inflation was at 2.9 in 2018 at its peak before Powell started pressing another rate hike. Inflation right now is at 7.5 and we're at zero. You know what the federal funds rate was back then in 2018? Here. The federal funds rate was all the way up to 2 point, basically, for a about 10 rate hikes away from here.
Wow. And we're not even expecting, we're expecting five. Well, the
We're
market's
expecting
expecting
5.
five this
Yes.
year. Halfway
The
there at
the Fed
7.5% inflation rate.
7.5%. Yep, 7.5%. The last time we had this quote unquote Powell wanting to, basically what Powell wanted to do, which you got to give him some credit, is he wanted to get rates higher while he could because he had no ammo for the next drawdown.
Yep. And that's the
And
way to do it, honestly. That's the way to do it,
and
but
yeah,
you got to do it in positive growth environments, which that was not a positive growth environment.
and I think something to mention is the way that our models work, right? What you guys see when you go on our website at market-radar.com on the regime section and our system strength, this is all relatively live data. You know, it's obviously there's some lag in not the data, but in lag in the processing of the data because there's nothing that is um a real-time economical indicator. Everything has to be processed on a time series, right? Now, it can be displayed in real time, but the data it's analyzing, any type of average or any type of stochastic model is going to go back and require a lag. The problem with the Federal Reserve is their lag is much greater than what's marginally acceptable. Their lag is so great that their GDP, the way that they have nowcast models for their GDP, you could say whatever you want about their nowcast and all this other stuff, but they're basing policy on numbers that come out every quarter. GDP comes out every quarter. Now there's prelim, right? There's estimates in between, but their data sets are so backdated. Like, think about how out of touch they are. And this totally makes sense if you think about how they enact their policy. They're always one step behind. They're always making policy mistakes. Why? Because they're looking at data that's basically expired. And this goes back to the fundamental process of the Federal Reserve. They're economists by education, not by utilization. They are trained.
Classic book smart
Yeah. Yep.
situation.
Yep. They are trained in a manner that is replicatable and of the standards of the Federal Reserve. They are supposed to meet certain standards. But if those standards are outdated or behind, then everyone is always going to be trained into the same routine. If you look at mainstream media like CNBC, even Bloomberg, right? You got people on there talking about stuff that has no relevance. They need headlines, right? They need to get viewers. They need to get you to pay attention. Breaking news, nonsense. Why? Because it's their program. Everyone's got a program. We keep our program as much or as data dependent as we can because I truly believe my opinion doesn't mean shit, especially to you guys, because my opinion won't make anyone any money. Why? Because my opinion is my opinion. I can think a lot of things. I can think the Nasdaq's going to 12,000, or can think the Nasdaq's going to 15,000. What does that matter? Right? if I give you guys data points to reference off of, you can understand and make your own opinions, because this is where no one will talk to you about, or no one will explain this to you. Conviction matters. There's a difference between getting draw down 15% in a position. Now, as long as it's weighted properly, it's not a big deal. But if you get drawn down 15% in a position and your conviction isn't there, and this is likely due to leverage, because non-leveraged positions aren't sliding 15% unless they're options. But let's go back to the conviction part. If your conviction isn't there, you don't you don't trust what you're doing. You don't understand what you're doing. Even if you make money in it, you still don't believe you could do it again. That's why we give you the data points. You could take what you want of the data points, think what you want, go where you want, but you're making those decisions on your own. The public account is just basically showing you guys that what we do works. If you follow along, that's up to you. I don't expect any of you guys to follow along. I expect you guys to understand what we're doing in the context of of how we're doing it and how we're positioned for it. You guys should be able to take the information. Everything we lay out to you is so textbook. You guys should be able to morph it into your own way and understand where things are going and play it in your own way. We don't play weeklies, and we don't recommend weeklies because statistically they're a plan to fail. I know people that can trade weekly options that make money. I know people that do. I know that what they do is completely unrealistic for the average individual, though. So I don't even bother mentioning it to those people that follow us for that specific reason. I believe that life is short, it's worth enjoying. Sitting in front of a computer screen, we're watching every tick on ES futures or, you know, VIX, making sure that it's, going down if you're long calls or going up if you're long puts, is not worth it. Better off positioning your account for the cycle, the whole regime. Because at the end of the day, you can see by the regimes don't happen in a day. They're multi-month, sometimes year.
That's where
And
the old buy and hold
yeah,
comes in handy. Like
right.
buy and hold TMF during a deflationary regime with conviction. We have
Yep.
conviction because we have our model. We trust our model. Our model's proven itself for over decades. You get one TMF play in a deflationary regime that lasts 6 months, a year, maybe 2 years, if it's a recession, and you're making hand over fist. What was the COVID profit on TMF?
About 100 about 120%, a little bit over that.
Yeah, with
Now
conviction, where
now
you can
those that are
comfortably.
watch
Sorry, go ahead.
no, no, real quick. Those that are watching those that are watching, you probably see this bearish trend in between. This is irrelevant to the regime, because you have to look at, when we look at bonds, I've said this before, but I'll reiterate it. We look at treasury note futures because they're the most liquid and have the most volume. As you can see, it went neutral trend here for a few months, but the regime was obviously deep deflation. So even if you cut the position and bought back in, you're still in the same boat. You would have never shorted this or done anything. There was no bearish trend indicator. But going back to what you were saying, Artie, if I were to tell someone that we made 120% on bonds in COVID, they would think that I was trading Puerto Rican bonds or some zero coupon bullshit. No, it's just leverage, but it's intelligent leverage. And that sounds cocky or stupid, but it's not, because if I were to buy TMF in September of 2020, for those listening, TMF prior to COVID, when bonds flipped bullish trend in 2019, where the TMF was at 18. Once we got the risk off indicator in July or August of 2020, TMF was 43. If I were to take DDAP off and take our regimes out of the equation, you may have bought a dip in July of 2020, expecting, the whole talk at that point was interest rates were going negative. That was the whole word on the street. US treasuries are going to go negative. If you would have bought that and had no idea what regime or what context of risk you were in, you'd now be down over 50%. Or unleveraged, you'd be down what's that? 15, a little over 15% in bonds, you know?
Conviction matters.
Conviction matters when you know what you're doing. That's the biggest key. You know how many people I've sat next to that have conviction, and I look at them and they're sitting with their quotes up and they're like, "Oh, I'm gonna bang this right now. I got this." And I look at them and it's like their first time trading, like, in the last week wheat futures. I look at them like, "What are you doing? Have you ever traded this before? Do you know what's going on?" No, but it's gonna go up. Why? Because CMB says it is? That's why you have conviction? That's the big point I'm trying to get across. There's a difference between knowing and believing. And I say this to people all the time. You know something can happen, but do you believe it can happen? You know?
I
For
think
example, go ahead.
I was just gonna say I think that's a great place to end it. I
Yeah,
think
I think that is a great place to end it.
yeah. Thanks for listening, guys. If you have any questions, which I'm sure you will, we got our Discord, free to join. You're welcome anytime. You can find our Discord on our website or on our Twitter. Thanks for
Yep.
listening.
Our website, before you guys run, our website is www.market-radar.com, and our Twitter handle is at the Market Radar. Thank you guys so much and have a great week.